Hello everybody. Hi. Thanks for coming out. It's 4:20 in the afternoon. I'm sure you've had a long day, so I'll try to keep it lively as I possibly can. This presentation is called Avoiding Average, How to Really Grow Your Wealth in the Stock Market. And my ambitions for it are quite modest, really. I'm not going to talk about how to be an expert stock picker, even though that's my job. I'm not going to talk about how you can beat the pros, anything like that. I've got, as I said, much more modest ambitions. I just want to talk about how an average investor with no particular insight or particular background in this stuff, who's well informed, and he just does a couple of important things which anybody can do. I want to talk about what a well-informed investor, what they can hope to achieve reasonably, and I want to compare that to how people actually do. Okay, so I'm just going to start it off with a story, all right? So my dad has a friend, his name is Brendan. And Brendan's an interesting fella. He, when he was younger, he went off to the States, worked there for a while in software, I think it was, and he comes back to Ireland, which is where I'm from. And he sets up his own software company, builds it up, sells it when he's around 40 or so, and makes a load of money. And he's like, retires. He's made. He buys a yacht and all that sort of stuff. And so his whole thing for the last, he's in his 60s now, for quite a while. His whole thing has been, he's done his traveling and all, but he's got the investing bug. He's got all this money, he wants to learn, he was managing it, and he's been enjoying that. And so when I was in my kind of teens or something like that, I got into investing myself. I got on the path that I'm on now, and I went to university and I started studying it and whatever. So yeah, Brendan was delighted to see me going down this path, and whenever we'd meet, we'd end up talking about this sort of thing. And then I think the most recent time I met him, it was basically about a year and a half ago. We're out on a walk in Ireland. I meet him and I ask him the usual questions that how are you doing, Brendan? What's going on with your investments and your portfolio and all that sort of stuff? And he says, actually, I'm done. I've cut it out and I don't do that anymore. So, what's happening? I ask him, and he said basically that he did a job that had been hanging over him for a while, and he actually properly collated his returns from, he would have had several different strategies, different brokers, and he would have had an options account and overseas brokers and all this sort of stuff. And he did the job of properly consolidating his ins and outs and his returns. And after the end of it, he found that he was making 3% per year. So he looked at that number and he was just sickened. He's like, right, I'm not doing this right. This is wasting my effort. I'm going to stop. So he doesn't do that anymore. So he's making 3% a year, right? So, but if I were to tell you, if he's making 3% per year, he's actually doing significantly better than the average investor. There have been a bunch of studies, and they show that the average equity investor makes something in and around 2.5% per year. 2.5% per year it's awful. I think everyone can see that. 2.5% per year. Any investing strategy you can think of should beat 2.5% per year. If you're just going long stocks, if you're going long property, just sit and hold, and most commodities for the last 10 years, whatever you want to name, it should be 2.5% per year. But that's where we find ourselves. So yeah, I want to talk about my dad's friend Brendan, he's a stand-in for the average investor. I want to talk about what he doesn't know, how he went wrong, and what he should be reasonably expecting to achieve. So I've got 4 simple, concrete steps to go from 2.5% to 3% in his case to something much, much better. And I'm going to make a claim that the average investor can reasonably hope to make 13.5%. That's the number I've come up with, and I'll let you know how I come to it. So, yeah, there's obviously a big difference between 2.5% and 13 and a bit percent, but people don't really think in terms of compound interest and over time, how does it actually stack up? It's kind of hard to get a tangible sense of what the difference actually is. So, to help you out, I've got a hypothetical situation, right? You've got hypothetical investor stocking away £10,000 per year does for 20 years. So that's like an average investor's investing lifespan. If the average investor is making the average investor's returns, after 20 years, he gets a pot of, is it £281,000, which is, just to help you illustrate it, that's what that buys you. It's up the road in Haringey. But same investor, no particular insight in the stock market. If he's doing what I think are taking reasonable steps, if he's making 13.7% per year, there's a big difference. He ends up with a pot of 1.2 million, and that's a much bigger house he gets in Bedfordshire. Okay, so I'll rattle through them. 4 steps. 1, buy stocks. Okay, we're at the Master Investor Show, so I think people do understand a little bit about buying stocks and why you should do it. But start from the start, and it bears repeating. If you want to grow your wealth, stocks are the tool for the job. They're the best way it's ever been found to do it. There are other assets which do different types of jobs, and they're all useful in their own way. But if growing your money is your plan, it's got to be stocks. So yeah, you can run an option strategy, and that's great for generating income over time. That's good. You can live in a house, which is very helpful. You can borrow against a house. That's great. You can buy bonds, and you can know exactly, or almost exactly, what your money is going to be worth in a couple of years' time. So you can plan around that. So that's very helpful too. So they're all useful assets for their job. But if you want to grow your wealth, it's got to be stocks, right? So just worth drilling down into it a little bit. Why is it that stocks do their job so well? What works about them? I think there's 2 ways of looking at it, right? One is this kind of more romantic way, and one is a more sort of scientific way, and they're both right. They're just different perspectives. The more romantic way of looking at it is that when you're buying stocks, you're investing in people. So like when you buy a stock, you're now a part owner of a company. That means all that company's, marketers and scientists and managers and lawyers and all those guys, they're working for you now. They put in 50-hour weeks, they're slaving, they're trying to grow the business and make more money, and you benefit from it. The other way of looking at it is that the one I learned at university, the more sort of nerdy way of thinking about it, which is what economists would call an equity risk premium. And that's just a bit of jargon, but it's quite simple really. The equity risk premium just means like if you're willing to hold an asset whose value is very unstable, it goes up and down a lot, the market will compensate you for that uncertainty, and that gives you a little bit extra. So there's this like fundamental trade-off between uncertainty here and the amount of extra premium, the amount of growth you get. So if you're looking at it, the trend you see with stock markets over time is it's quite a wavy line, but the trend is very distinctly upwards. So lesson 1, buy stocks, fine. But I said the average investor makes 2.5%. If you know a little bit about stocks, you know that they return on average about 5 to 10%. FTSE returns something like in that region for the last 10, 20 years. So what accounts for the difference? Why does the average investor do so badly? Shoot themselves in the foot. They do it there's a couple of different ways, but it all roughly falls under the category of overtrading. Investors have a tendency they lack patience, I would think is one way of describing it. They call their broker too often. They learn about a stock, they get excited about it, and maybe then they lose patience with it, they get bored of it, and they want to move on to the next one, they want to make the next deal. That doesn't really make them any better investors, but it adds up their costs. It means that they're giving more money to their broker, and over time that eats into their returns. Another way of describing it is that investors, the average investor has a habit of timing the market quite poorly. So people tend to buy in when the market is at its top, when markets kind of cross over into the regular news, say, or when your friends or your brother-in-law or whoever is making money in the stock market and talking to you about it. That's when people get excited, that's when people put their money in, and that means that they tend to buy at the top. Equally, when the markets are at their worst, when there's a lot of fear, when you look, the Daily Mail has a worried-looking trader guy on the front cover, that's when people will tend to sell. So the effect is that you're buying high and you're selling low. Over time, that badly eats into your returns. So timing the market, it's a bad idea. You shouldn't try to do it. And there's actually some evidence about that. We know in 1960, in the States at least, that the average investor would hold a stock. When they bought a stock, they'd hold it for a period of 8 years, right? And that number has just been falling over time. 1970 it was down to 5 years, and then it falls 60s, 50s, sorry, 80s, 90s. The most recent number we have, I think it was from 2014, but the most recent number is that the average investor buys a stock and holds it for 17 weeks. It's the average holding period for a stock, and that's crazy. If you're going to be if you want to invest in the stock market, if you want to get the benefit out of investing in the stock market, you need to have the patience. You're never going to grow your wealth by investing in a company and then dumping it within 1 quarter, moving on to the next one. It's incompatible with investing in stocks. Okay, rattling through them. Third lesson. So, I'm not sure I even did I introduce myself? I don't think I did. Sorry, I'm Sean Keys. I'm the editor of the Penny Share Letter. So I'm a small cap guy. I write a newsletter advising people on how to invest in small companies, and I research the companies and I give them a portfolio. So I'm a small cap guy. Hands up, that's full disclosure, but I just want to justify why I'm a small cap guy. Small caps behave like stocks, but more so. I said that stocks are more volatile and that the market gives you a bit extra to compensate for that. Small caps are even more like that. They're more volatile than stocks even. The market gives you even more to compensate for it. And over time, you see it very, very clearly, many markets, over many decades, that small caps just return quite a lot more than large caps. And I mean, okay, obviously investing in small caps is, you can get it intuitively, right? You're investing in a small company. A small company has got a greater sort of potential to grow because, you know, a small thing can grow more quickly and can make a bigger move than a large thing. Just simple inertia. Okay, so all right, we've had 3 lessons. It's fairly straightforward, you probably will have heard of them. Buy stocks, fine. Don't shoot yourself in the foot, and buy small cap stocks. All quite straightforward. The 4th thing I want to talk about is basically what I build my investing strategy around. And maybe it's a bit more obscure, you might not have heard about this, because it's quite a new idea. It's new because it's based on some research from 2015, new research from economists out of a hedge fund in America called AQR, a big American hedge fund, and some other economists at different American universities. And so these guys, right, they were interested in, not particularly in small caps, but they were interested in this question of quality. They wanted to know how quality affected returns in the market. So they had this big data set, going back to 1948, I think it was, 18 different countries. And they're trying to test this question of how quality affects returns. So I'll just quickly pause. What's the definition of quality? What do they mean? They're very simply talking about the things that an investor would be willing to pay more for. So you can kind of, if you forget about the actual security that's sort of trading on the stock market and its price and its volatility and all that sort of stuff, just think about the company itself and its accounts. Like, what makes a good company? You know, what would you like about a company? What would you be willing to pay more for? So they had a kind of a broad definition of quality. They were looking at profitability, different measures of profitability, growth is obviously good. They're looking at safety, how volatile and how much debt the company has, and whether it's run in the interest of shareholders. Okay, so that's the definition of quality. They're investigating quality. They find, firstly, that there's a very strong positive returns between strong relationship between quality and returns. That you can actually just make more money in the market by buying high quality companies, which strikes me as a sort of a strange finding, because you would think that the market would be efficient enough that you couldn't make extra money just by buying quality, but that's what they found. So they found that you can make extra money by buying quality companies. They found that the inverse is also true, that low quality companies tend to lag the market's performance. And they found that quality isn't just like randomly distributed all around the market. It lives in particular places. They found that high quality stocks are very common at the very top of the market among big companies and blue chips. And conversely, that low quality sort of junk stocks are very common at the bottom of the market among small caps. So again, we're at the Master Investor Show. I'm going to guess that there are some AIM investors in the room. And I think if you've been around AIM for a while, you'll have an intuitive sense of what I'm talking about here. You're talking about companies that they'll basically promise but don't deliver. The companies that don't generate much cash. Companies that dilute their shareholders again and again. If you've been a name investor, you've come across these companies. You've surely owned a few. It's all right. So they found quality, you get extra for investing in quality. Low quality is companies lag the market, and there's lots of low quality companies at the bottom of the market. So right, that begs the question. What happens to the returns from small caps if you get rid of all these low quality companies? So they went back 1 year later, another study, and they looked at exactly that question. And they found, you can guess the punchline, unsurprisingly, they found that if you cut out low quality, junky companies, you get your returns from investing in small caps get a big boost. You get 6.7% per year is the number they came up with. And that's robust across different markets, across a very long time period. So when I said 13.7% per year, that's a big part, a big component of that. 13.7% per year is the number that an informed investor can reasonably hope to get. So yeah, that was the first thing they found. They found that once you get rid of low quality companies, returns go up. Second thing they found, remember what I told you before that the market compensates you for taking on risk? If you're willing to hold an asset whose value is volatile, that goes up and down a lot, the market will give you a bit extra to compensate for that. Well, they found that that's not what's happening here. You're not taking on extra risk. You're just getting the extra return, so it's sort of a win-win. Third thing they found, that actually this is interesting, that they found that once you take this step, get rid of low quality companies in small caps, that it obliterates any extra premium you get for buying value, right? So that's, I'm guessing again, Master Investor Conference, there won't be too many stock market analysts who will say that value doesn't matter. Well, that's what I'm saying, at least in this very specific context. Among small cap companies, among high quality small cap companies, you don't get anything extra for buying value. So that means that there's a much broader universe of companies that you could look at. And the fourth thing that they found was that this effect is stronger and stronger the smaller the company that you're looking at. Right, so that's the 4 lessons. How an average investor can get from 2.5% to 13.7% per year, from that dungeon I showed you in North London to the much bigger house in North London. So I'm the editor of a newsletter, a Penny Share letter, and basically what I try to do in my newsletter is take all these ideas that I've been talking to you about and just put them to work for the readers, and just to put a simple, easy to use face on all of this research and all these ideas, and come up with a portfolio that actually lives up to the ideas I've been talking about. So practically, what do I do? Very simple. I went to a financial software company, Standard & Poor's. I got a sort of industrial grade stock screen, and I programmed it. I basically programmed it in the same way as the researchers programmed their historical backwards looking data. So those guys were looking backwards and they were making this particular, testing this particular hypothesis about how quality affects returns. I've got the same thing, except for it's looking forward, and it's constantly generating me a live sort of short list of high quality small cap companies I can look at. So just specifically, I'll go into a little bit more detail. What's in the screen? What's in this formula? So I said that they're looking at 4 rough things. The first is profitability. So within profitability, they're looking at companies with a high return on equity, companies that generate cash, with higher cash flows, companies with wider margins, different types of accruals as well. They're looking at like gross profitability. Second thing they're looking at is growth. So that's just simply looking at how those first profitability numbers change over time. Third thing they're looking at is safety. So that's one, like the market beta of the stock, how much it moves around. Also, you've got the Altman Z-score, which just tests for the company's robustness, basically, the robustness of its balance sheet, and debt as well. And the fourth thing we're looking at is whether it's run in the interest of shareholders. So that's whether the company is giving back to its shareholders, whether it's very importantly for AIM investors, Allure is the type of company which dilutes its shareholders. Also, dividends if it's in a position to give them. And yes, that's the most important part for that. So that's basically how I work. I take the research, I build a screen, I find high quality, small cap companies. I use that to generate extra returns, and that is what you need to know about how to live up to your potential as an ordinary investor. And that's it for me today. Thank you. Yeah, I've got 5 minutes for some questions if anybody would like to get involved.
How often do you send a newsletter?
So the gentleman in the front asked, how often do I send the newsletter? Basically, it's a printed newsletter, goes out once a month. I research one company every month in detail, so for 5,000 words or so. And then I maintain a portfolio of the companies that I'm recommending. And then weekly, I'll get in touch via email, just electronically, and I'll update on company news, anything that investors need to know, maybe any buys or sells that are happening at that moment.
I'm next. Right. Sorry.
I'll answer that in just a second. Sorry, does someone have a microphone?
Yes. Right here at the top.
Hi.
I just wanted to ask you, I've seen a lot in this industry about so many companies. How can you avoid conflict of interest? Very small companies, they pay people like writers of penny newsletters to advertise the companies.
Yeah.
There's a lot of conflict of interest
Definitely,
in choosing the right companies.
Yeah.
How do you avoid that?
Well, that's a good question, and I'm very happy. I work for Agora UK, and we run investment newsletters, but sort of baked into our entire business model is that we're only paid by our subscribers. We don't take any money from advertisers. We advertise our own products within our emails, let's say. We don't take any money from brokers. We don't take any money from the companies themselves, absolutely. So we live or die based on the quality of our ideas, whether our subscribers are happy. If they don't like us, they leave us. We give them a money back guarantee, and it's a very simple, clean business model from our point of view, and I think it answers your exact question, puts it to bed quickly.
So in terms of sort of tips or guidance you provide, would you only focus on companies that have got established sales, because otherwise you could argue it's just gambling?
Yeah.
Pipe dreams, perhaps?
Yeah, so the gentleman at the front asked whether I would stick to companies which have established sales. Yeah, that's basically the sort of thing that this talk is, that the quality screen is looking for, is screening out for. You're looking not companies that not alone have sales, but that companies that are already profitable. So you're going one step further. What that means is you do screen out some great high potential companies which are on their way to the top. But again, the issue is AIM is rife with junk companies which promise a lot and which seem like they're going to the top. And you'll over time, it's not a winning bet to continually try your luck with an AIM company which seems promising but doesn't have much to show for itself yet. So that we sort of tie our hands behind our back in that respect, and we look for companies which are already somewhat proven, and that's kind of the crucial intuition behind this. Yeah.
Hello. Yeah, a couple of questions. Do you publish the portfolio results so that we know how you've done? And the second question is, do you make sell recommendations as well as buy?
Yeah. Well, first question. Yeah. Well, I publish the portfolio continually for subscribers. I guess maybe the question you're asking is like, how have you done?
Exactly.
Yeah. And okay, look, the portfolio's been up and running for a year and a half. I'm happy with the performance. Because the portfolio has been built one stock at a time. So like it started in August of 2015 with one company, and then two, and then three, and then four. And just for that reason, it's difficult to have year-over-year kind of performance comparisons, because then you're looking at the performance of a portfolio with 5 stocks versus the performance of a portfolio which grew to have 18 stocks. But anyway, it's been good. If you just took a very, very simple, basic calculation of chuck them all in, give them put £1,000 into each of them, how much more is that thing worth than it was at the start? I haven't checked the most recent number, but it's up like 45% the last time I checked since September of 2015. So the performance has been good. I'm happy with it. And what was your, sorry, you had a second question. Oh yeah, do we issue sell recommendations? Yes, we do. We sold a couple of shares, yeah. Go on, go for it.
Well, you say that that's only been going since 2015, but I know the penny share that you've been going for about 20 or 30 years.
Well, that's a predecessor of it, and so I took over from David Thornton, who was the editor of a newsletter called Red Hat Penny Shares, and the reason that we relaunched it, but it wasn't just a sort of a lick of paint. This whole philosophy that I've been talking to you about, I brought it in from day one. So I felt it was appropriate to start again with a new portfolio, and for it to be a newsletter that was built around this particular idea, this particular piece of advice, and then build a portfolio from it. So yeah, like Agora has pardon me?
Is your record better than the old one? Because I didn't find that all successful.
I can't comment about the old ones. I just, you know, I can tell you about my record since I've started. It's only been a year and a half, so it's early days, but I'm happy so far. Okay, any more questions? One last one, okay.
Are you able to talk about your biggest losers or winners to date?
I can't talk about companies that are within the portfolio. I think my subscribers wouldn't take that well. Yeah, biggest winner you've had to date. I can talk about the biggest loser to date. I'm happy to do that, I suppose. Biggest loser to date was TrackMate. I'm not sure if anybody knows TrackMate. It didn't go well for me. It's yeah. This is perhaps a really dull way to end the presentation, where I talk about the worst performing company I've ever bought, but that's what it is.
That's still going, isn't it?
TrackMate's still going, yeah. It didn't collapse. It went down about 60% from when I tipped it. Okay, but I can tell you that the best performing company, even though I won't tell the name of it, is up currently close to 400% or something like that. So, okay, yeah. One more. Yeah, I do. So I do issue seller recommendations, yeah. So the subscribers, they get, like, you get a portfolio which is kind of, I manage it for them on a daily basis. I'm checking the RNS. I'm writing to them once a week to let them know what's happening. And when it comes time to sell a stock, I'm selling a stock. Okay, I think that's it so yeah, thanks for everyone. I know it's the end of your day, so I greatly appreciate it. It's been a great audience, so thank you.